What's up everyone, I am 7-Star Mike and today's video is on position sizing for risk management. Now this is an excerpt from the video I did with River on our What Went Wrong episode, and if you want to see the full episode of that, it is available on YouTube as well. This is the specific portion where I show the example of how you would calculate position size for risk management. Now, most people don't watch the full videos. We have statistics on YouTube that show us that, but this one's important. I cover pretty much how to determine your position size based on a chart entry. We do talk for a little bit about it, but it covers a lot of information that is vital. So I do suggest watching the whole thing this time. If you guys have any questions, hit the comment section below. I will go through and answer any questions you guys have on this. And let's take a look at position sizing for risk management.
As an example, because I can talk about it all day long, but if you're trying to visualize what I'm saying, it's a lot harder. So I have a specific chart I'm going to look at. It's real based on the chart, but it's kind of a fake trade thesis as far as if this was something you wanted to take, this is how we're going to go about it. So key thing to remember, I am not recommending this as an actual trade setup. This is just an example of how you can look at a chart, come up with a trade thesis, and basically manage that trade. The other thing to keep in mind is that this is just an estimate. There are other factors that go into options prices that I'm not taking into consideration right now. So for those of you that are new to options, there are so many factors that go into how an option is priced. And I'm not going to go into it here because one, it's very complicated. Two, I don't even know all of it. And not that I don't know how it's done, it's just such a complicated mathematical formula that I've never looked into the details of how it's calculated, and I don't care. But what you do need to know, if you don't want to go into the mathematical part, is that there are multiple factors that go into what makes an options contract what it actually costs. Okay, so today, in this example, we're not taking into consideration theta, which is time decay, which means every second you're in an options contract, it's losing a little bit of value because it's getting closer and closer to expiration. Even if it's going in your direction, you're in a call and the underlying is going up, a little piece of that contract is losing value just because of the time factor. So we're not taking into consideration IV. So again, the example I'm giving you today, you can use this as an estimate of what your contracts are going to do and how you would position size based on that, but it's not going to be an exact, okay, it did this, so the contract's going to be worth this. You've got to take in those other factors that we're not going to talk about today. Okay, so when you're thinking about a chart, and I want to get in here, this is my trade thesis. What I'm going to show you guys today is an estimate of how you would go about sizing that position based on the chart. So here's our fake trade thesis, and I say fake because it's not my actual thesis right now, but this is a live chart. Okay, so we're looking at MU. This is the daily chart for MU. You can see right over here at this point, this was a resistance point. It hit that level and dropped, okay? We did get over it here, we did get under it here, but this is what I'm looking at Friday. It hit that level and then bounced. So this prior resistance level on Friday actually became support. Now it wasn't an exact touch and go, but it's very close to that area. So you can see prior resistance became support. So, and you can see these 2 days in here, it was pretty close also. It did breach that level, but we can basically say that level held. So that's $89. The actual level on the chart, I think it's pretty hard for you guys to read. It says over here, it's 89.05. So to make the example really simple, we're just gonna make the numbers easy. We're not gonna say 89.05, we're gonna call it $89, okay? So $89 support because it was resistance here and it became support, support, support. So our trade thesis is we want to be in calls for MU if it's above this $89 support. Now, if we look at Friday's chart, this is a 1 minute chart for Friday, you can see what it did at that $89 level. Okay, so it bounced, it breached it, but it basically held, it bounced again, and then it went on a little bit of a run upwards. So you can see Friday, it held that $89 level. So ideally, you would have wanted to get into a position here if you were swing trading and if we were in a swing environment, which I don't believe we currently are. My personal thoughts, maybe we are, maybe we're not. For me personally, I don't want to swing too much right now. I'm short-term trading most everything I touch. So this is what happened Friday. Remember, our thesis is we want to be in calls if it's above this $89 support. It hit that level and it's above that. So our thesis right now is tomorrow we're going to open call position for MU. Now, it closed Friday at 90.83. Okay, let's just say that tomorrow MU opens at the same price. And again, we're going to round up to make the numbers easy. So let's just say tomorrow MU opens at $91. Now, it could open at 101, it could open at 61. I have absolutely no idea. So again, I'm not saying it's going to do this. We're just using an example. Okay, so our assumption is that it's going to open at $91, which is basically right where it closed Friday. Our assumption is that we're going to buy calls based on that prior support of $89 holding. And for this example, we're going to say our maximum trade risk is $500. So any trade I enter, I'm willing to lose $500 before I say, you know what, I've got to cut this trade. So without picking an arbitrary place on the chart and say, I'm going to get this contract here and I'm going to buy 10 of them, and maybe it drops 5 cents and then 10 cents and you're freaking out going, oh my God, it's immediately working against me. If you know your max trade risk is $500, how many contracts can we buy for that $91 call for MU? Now, if you look at the bottom here, it says the bid and ask on Friday's prices. Okay, so this options chain is Friday. So these contracts right here, the bid 226, the ask 236, that's not where these contracts are going to open tomorrow. Okay, so again, we're just using an actual chart and an actual options chain to make it easier to visualize. These are not going to be the prices where it opens tomorrow, but we've got to use something so it's easier to see rather than just visualize. Okay, so if our maximum trade risk is $500, how many contracts can you buy for that $91 strike with proper trade management? Now there's kind of a hint on the screen there. If you guys are going, oh my God, I have no idea, well, you're in luck because I'm going to show you. Okay, so the trade thesis, again, MU, calls above that $89 support. If your trade thesis is to buy the calls based on the prior support of $89 holding, where's your trade invalidated? I'm not reading the question box. So Riv, if you can look at that, does anyone know if your trade idea is to buy calls above $89, as long as that support holds, where's the trade invalidated? Who's got answers in that question box there?
We got several people saying below 89.
Okay. So your thesis is that the support of $89 is holding. So if MU were to reverse and break back below 89, that's the support area we're watching. So if it breaks below 89, that's where our thesis is invalidated. So we're going to cut that trade for a loss if it breaks below 89. So there's the fun part at the bottom. Now let's calculate position size for this risk management. So how much room does the underlying ticker have before it would reach that support if it were to reverse? Now remember, we're just making up this number, but tomorrow, if it were to open at $91 and support is at $89, we've got that potential $2 drop. If it was going to drop and test that support area again, we don't know if it will, but we know that that $89 is a pretty solid support area. Okay, so our thesis says if that area holds, we want to be in a call position. So we have to understand that it can potentially drop from 91 to 89, and that's a risk that we're going to take if we were to open a position, if it opened tomorrow at $91. So what we need to do to figure this out is we're going to look at the delta of the contract that we're going to buy. Now, since the contract, or since the underlying is opening at 91, again, I'm just randomly picking an example, we're going to use a $91 call. And in this example, I'm just using the weekly contract. Just again, this works on any time frame and any trade type. You just have to use the formula that we're using now and put it on a different time frame. You can use this on 2 weeks out, a month out, a year out, whatever it is. So I'm just using the weeklies as an example, but you can do this for if you wanted to take the March contract. So this is the $91 call right here for MU, $91. There's the expiration February 25. So we want to look at the delta. The delta on this is 46 cents. So that means for every dollar that the underlying drops, so MU, the ticker itself, goes from 91 to 90, this particular contract will drop 46 cents. Okay, so the ask is 236. Remember, those are Friday's prices. We don't know what it would be tomorrow at open, but we have to use a number. So we're going to use Friday's price, 236. So if MU opened at $91 and dropped, actually it's 90.8. So it's not exactly, again, remember, we're rounding up. So if MU were to drop $1, this contract would drop by $46. So it's 236 now on Friday. Based on the delta, if MU drops $1, we would lose 46 cents. So this contract would be worth $1.90. Okay, that's what delta is basically referring to. If the underlying drops $1, the delta is how much this contract will lose. Or if the underlying goes up $1, the delta is how much this contract will gain. So going back to the example, if the underlying was to drop $2 back down to test that support area again, that $91 call contract would lose $92, right? So your delta is 46. That's per dollar of the underlying move. So if the underlying is going to move $2, you're going to times that delta by 2. So 46 times 2 is 92. Hopefully I'm not losing you guys, because this is something you kind of have to just wrap your head around, and it's probably confusing at first, especially if you don't know what the Greeks are. You're going, delta, what is delta? Right? This is something we just kind of take for granted as options traders. So we can look at this and kind of formulate this idea in our head instantly. If you're new to this and this way of thinking, you're going, oh my God. So this will be available on YouTube. You can kind of go back and watch this over and over. So delta is the amount the contract will move for $1 move in the underlying. We're saying MU opens at 91. It can potentially move down to $89 of support. That's a $2 move. Take your delta of 46, times that by 2. This contract, if you have a single contract, will drop $92 if MU opens at 91 and drops to 89 to test that support. So if your max loss is $500, you can't buy more than 5 contracts. Because if you do enter at 91, and if it does drop to $89, with that $2 downward move to test support and a position size of 5 contracts, your loss would be $460. Now your max loss is $500, this loss would be $460, so there's a little bit of wiggle room, but that can also take into account your IV moving or theta or whatever else. So you have a little bit of a buffer there. But if you bought 6 contracts, if it drops down to that support level, your loss is 552, and your max loss you're stating is 500. So you can't risk it moving 552 if your max loss is 500. So you have to take a 5 contract position size here. Because remember, what we're doing is seeing if we enter at 91 and if it drops to 89 as support, that's how much we're going to lose. If support doesn't hold and it breaks below support, that's where you're going to exit, right? So this 460 that I'm mentioning here for 5 contracts, that's if it hits that support level, but you're not going to close the trade there. You're going to close the trade if it breaks that support level. So your 460 is actually going to be a little bit more. Does that make sense so far?
Yeah, let me jump in too and say what you're saying with the 5 contract, that is assuming an extremely disciplined exit discipline, right? Because that's getting out when it breaks your pre-planned 89. That's not holding on waiting for VWAP. That's not holding on to see if it's going to reverse. That's an extremely big part of this, is you're assuming this. And a point that we all need to take into consideration is that means, okay, the trade is invalidated at 89. 7-star Mike is going to kill it right below 89. The exit.
Right, but remember, our trade thesis is to get in because 89 held. It wasn't to get in because VWAP is here or the 34 is here. It's we got in because 89 is holding as support. So we're going to exit if 89 breaks.
Not going to question it. That's the plan. If 89 breaks, we're out.
Now, here's the thing. I will say this also. In the support and resistance video I did, I'm giving you guys levels, right? Support and resistance isn't always a specific number. So in this example, so what you just brought up, let's say 89 breaks as support and you have VWAP at, what am I saying? So 89 is support, and let's say VWAP is 88.77, right? In that case, yes, I'm going to give it down to VWAP, but I'm not going to say, you know, because 89 won't hold as an exact number. It might be 88.80, 88.93 before it bounces, right? It doesn't have to be that exact level. So if VWAP was right below that for the day that we're looking at, yeah, I might say, well, let me see if it bounces off VWAP. But it has to be very close.
Right.
So if we're looking at 89 as a support level and VWAP is, you know, let's say it gaps up or something and VWAP is $3 lower than that, no, I'm not giving it that $3 move to see, well, you know, it broke support, but VWAP is $3 lower. Well, it broke VWAP, but the 34 EMA is $6 below that. Well, it broke that, but there's another major level of support below that. You know, you can't keep lowering it.
That's right. That's the problem. And a lot of people calculate their max risk by simply the premium they're paying. That's a common thing I'm hearing too. And
I love that you mentioned that, because my very next slide.
Yeah.
Why can't you use a set percentage as a stop loss? I hate when people say this. They say, oh, you know, I stop out at 20%. And my first question is why? What does 20% represent? It represents nothing. The market doesn't know or care about what 20% means to you. That's a random number that you chose. It has no market significance whatsoever. Now, when you're starting out as a trader, you can say, hey, when I make a 10% gain, I want to sell it. I just want that feel-good profit. I want to know I can get into a trade, profit, and cut it. That's fine. But as you get experience and you move into, if you want to do this full time, you can't take these set levels as gains or losses. So in this case, at the ask of 236, 5 contracts is going to cost you 1180. If the underlying dropped to test support, that would be a loss of 460 bucks, right? But we're saying our max loss is 500. So if it does drop to support and we're down 460, this is still a trade that we're going to be in. However, that $460 loss is 39% of the position. So if you have a 30% stop loss, you're going to stop out right before it hits support and then bounces.
Yep.
Now remember, if it does drop that much, it is still a valid trade, because you're saying if it holds support, I want to be in calls. So if it drops all the way down to support, you don't close the trade. You're still in a valid trade. You're down 39%, but you're still in a valid trade. So you wouldn't close the trade just because it dropped there. You're only closing if it breaks that level and doesn't hold support this time around. So if you're in this position and you're down 39%, you're in a valid trade based on the thesis that you set to start. So if you just say, well, I'm going to cut it at 30%, you cut it at 30%, it drops just a little bit more and then bounces and reverses. And how many times has that happened to you guys? Have you ever cut a trade and then, 6 minutes later it reverses and you're going, oh my God, I just cut that trade and then it reversed?
Yeah.
That happens to a lot of us, right?
Yeah, it's the feeling that the market hates you. Like the market was waiting for you to go long, and now the market's going to bleed out just because it hates you personally.
Right. But what did you really do? You sold a call contract right before it had a chance to hit support and bounce in reverse. So when you take these general, oh, I want, and we do it all the time with the $100 chuck, right? The contract is up $1, we're going to close it. We do that. It's not the best way to trade because that $100 is an arbitrary number. The market doesn't know what you got in at, so it doesn't know what $1 up from there would be. That's not how people buy and sell contracts. That's how amateurs do it.
Yep.
And like I said, we $100 chuck from time to time also. So I'm not trying to put down people that $100 chuck. I do it, right? But for most of my trading, I'm not going to sell it based on an arbitrary number of $100 gain. I'm going to close it. Up 20%, I'm going to close it. Down 25%, I'm going to close it. You can't do that because the market doesn't know what these levels are because it doesn't know what level you entered at. And it doesn't respond to that. It just doesn't care, right? So what you don't want to do is have a 30% loss. Remember, this is $89 support. We're getting in up here at 91. What you don't want to do is have it come up here and you're going, oh, sweet, I got a good entry. It comes back to test this level. Remember, this would be with 5 contracts. And the example that we chose, this level right here, you're down 39%. So let's say it gets to this candle, you're down 30%. You cut the trade, it hits support, it bounces, little retrace and goes on a run. And you're out here going, oh my God, I was in that trade. It would have done exactly what I wanted it to do. Well, what happened? You cut it at 30%, but the support level that it was bouncing at would have needed a 39% drop in those particular contracts, right? So if you're cutting at 30%, that's an arbitrary number. No one knows or cares what 30% means. If you cut it based on the chart, this support level held, I'm staying in the trade. This support level broke, I'm closing the trade. Whatever that percentage gain or loss is right there, it doesn't matter. It's the fact that this is a support level. We're in the trade because it's holding support. We close the trade if it breaks support. So you don't want to close it somewhere up here for a 30% arbitrary number of a loss and then watch it touch support and then bounce and run.
Yeah, I see you all the time putting forth this advice. People ask you many times each day, you know, when should I sell? What's the thing? And you're always saying support and resistance. Like that's the key to all this. And I know that a lot of people simply calculate their, I did this in the early days myself. How much are you comfortable losing with this trade? Okay, so I can lose whatever, 15%. So that's their stop loss. And that is completely disattached from any notion of support or resistance in the chart. So that's one of the great things you're bringing to this.
But think about why, right? You and I are going to enter the exact same trade.
Yep.
We see the chart, we say, okay, and let's just use these numbers as an example because we've been talking about them. They're fresh in our mind. If this stock bounces off $89, I'm going to enter a call position.
Yeah.
You see it bounce off 89, you get into a call position, your contract costs $3. I'm eating a bagel. I come back to my screen, I say, oh, wow, look, it bounced off of 89. I'm going to enter a call position. By the time I enter the position, it's $3.40. If we just say, I'm going to cut this trade at 15%, well, you're in at $3, I'm in at $3.40. 15% is 2 completely different numbers for both of us, and we're in the exact same trade for the exact same reason.
That's right. That's right.
So it doesn't make sense to say 15% because where did you enter? You know, how does that 15% compare to the chart of support and resistance? If that 15% is nowhere near support, you don't want to cut a call while it's above support. So if you're just randomly using that 15% level, and again, I'm just making these numbers up, but whatever it is, I have a 30% stop loss. I have a 50% stop loss. I know the Nigerians say all the time, if their position hits 50% down, they cut it. No questions asked. Down 50%, they cut it.
Yep.
But what if you're down 50%, but a major support level is 2% below that, right? So you got to look at a chart and see where does it make sense on the chart to close out this trade. And if it doesn't hit that level, I'm not closing the trade.
Yeah, that's right.
I'm not closing it because I'm down $500. I'm closing it because it hit support and it didn't hold and support broke. It's a broken trade. I am out of the trade. I sized the trade such that it would be about $500 when it hits there. So I'm not closing the trade because it's down $500. I size the trade such that if the trade is broken, it would end up being about 500 bucks. So it's not the 500 bucks that's getting me out of the trade, it's the chart. And
That's
I'm
right.
position sizing the trade such that if it breaks, it would be $500 if that's your max loss. Remember that I'm just using that number as well. You might look at your account and say, hey, I can't afford to lose a $500 on any single trade. So again, I'm just picking an example here. If your max loss was $100, you would take 2 contracts, I think. I'd have to go back and no, you would take 1 contract because that $2 of a drop represents $96. So if your max loss was $100, you can only take 1 contract to allow it enough room to go back to support and see if it holds. And if it does hold, then you stay in the trade. If it doesn't hold, you've got to cut it because you're down $96 now at support. So if support breaks, maybe you're down 100, 105, 110, and your max loss is 100, so you're right about there, and that's where you would cut the trade.
Yeah, here's a good point too. Everything that is in the chart is objective, like it's outside of our brain. And things like the Nigerians 50%, which I don't know if I believe that because they know charts. I wonder, it just makes me wonder, are they really cutting everything at 50% regardless? Anyway, but set stop loss percentages or amounts I'm comfortable losing, those are all subjective. And like you said, the market doesn't care about our subjectivity. So what you're saying is the objective reason to enter, to exit, to add to pull back is in the chart. And that's a great.
If you're not watching the chart, you're guessing.
That's right.
No, this is for technical analysis, right? You can have a fundamental reason to get into a trade. And you say, hey, they beat earnings by 10%. They're guiding up by 10%. The stock should be up 10%. So I'm going to enter a trade here. And I think the stock is going to increase in value by 10% over the next 3 months, 6 months, whatever. You're not going to close that trade based on the chart because you're using fundamentals to enter that trade. Yeah. So as a technical analysis trader, I'm trading based on the chart. So I've got to use the chart as my guide for enters and exits. If I'm trading on fundamentals, which I don't do, I couldn't tell you the first thing about fundamentals because I don't trade that way. I understand them, I know what it is, I just don't trade that way. So that's a different mindset. That's a different, let's just say trade mentality. It's a different criteria for entries. So for what we do for the most part, if you're talking about the chat room, and if you look at what I post on Twitter, it's technical analysis entries. So based on a technical analysis type of trader, the chart guides you. You're entering and exiting based on points on a chart, which represents supply and demand.
Yeah, our good friend Kang recently tweeted, he lives and dies by the chart.